Good evening, everybody. Hope everybody's having a nice summer evening now. We had a nice 2 days of spring here in Pittsburgh. So tonight we got the great pleasure again of having Vince Vora with us. He's going to show us some of his options trading strategies. So I'm not going to take up any of his time. Vince, welcome back to the Candlestick Forum. We always like to see your information.
Thank you so much for having me on, and welcome everybody. It's great to be with you tonight. These are interesting times, of course, that we're trading in, and one of the biggest things that I'm most concerned about on a regular trading day, let alone this environment, is risk. And so one of the ways that I control the level of risk that I take in the markets is with options. There are a lot of strategies that you can use to, find entry and exit points. And I'm sure all of you are familiar with Stephen's strategies, which are fantastic and work very well. What I do with options is take a strategy that works for me and make it a lot safer trading options. So that's why I wanted to talk to you about options tonight. And I just want to go through some very simple tactics and option strategies that you can use, but ones that I believe will be very effective for you and easy for you to use. Okay, so let's get started. First of all, as Stephen said, I'm Vince Vora. I'm the head trader here at Trading Winds, and I have been doing this for well over 30 years now. Over that time, I've developed several of my own strategies, but really over the past 7 years or so, almost 8, I've been focused on coaching individuals, both in a group format as well as one-on-one, and it's been a lot of fun. Tonight, as I mentioned, I wanna cover the basics of options, what they are, and really who and how you can actually make money in the options market. And then I want to share 2 at a minimum, hopefully 3 strategies with you tonight if we have time for all 3. And of course we do want to leave some time for questions, but by all means, as we go through this, if there's something that you hear and you have a question on, by all means type it in. I'll try to keep an eye on the chat as we go through it. If I see your question, I'll answer it. If not, we'll wait till the end, and I'll be happy to cover as many questions as we can. Now, before we move forward, I do have to remind you that trading can be risky, as well as options trading. It can absolutely be risky. So please don't trade with real money until you are completely comfortable with the system you are using. So let's get started and talk about call options to start with. Give me one quick second here. There we go. I just have to make an adjustment on my side. There we go. So a call option, most of you are probably familiar with, but if you're not, let me just give you the technical definition of it, and then we'll go over how I use them. But a call option will give you the right, but not the obligation. And this is one key point. When you own a call option, when you're the buyer of an option, whether it's a call or a put, you decide whether or not that option contract ever gets exercised. Okay, so you are in full control when you are long that contract, when you are the buyer of that contract. If you're the seller of it, then you're at the mercy of the person on the other side that can exercise that option anytime between when you buy it and that expiry date. Okay, but a call option will give you that right to buy a specific stock, depending on the number of contracts you buy, at a fixed price, which is known as the strike price, anytime before a specific expiration date. When I bring up the option table, I'll explain it again. It'll probably be a lot clearer then, so don't worry if this is gets a little confusing for you. The option seller, as I said, is obligated to sell you the stock at that specified price if if the buyer exercises that option before that expiry date. Okay. Now, another thing to remember is when it comes to the risk that you have on the table with a long call, and let's stick to calls for with a long call, your profit potential is unlimited because theoretically that stock can keep going up to infinity, right? But your potential loss will always be restricted to what you paid for that call option. So if I'm paying $3 a share for that long call, that is the most that I can lose ever. Okay, because remember, you're in control. No one can exercise that contract. Only you, as the buyer, can decide to exercise that contract. And so the most you can ever lose is what you pay for it. Okay. Now, oops, my mouse is going a little crazy here. Let me try this again. Short call. If you're the seller of that short call, the money you receive for the sale of that call is the maximum profit you can ever make on that position. Okay. But on the flip side, your potential loss now becomes unlimited because that short call, for you to cover it, you'd have to go out to the market and buy the stock to cover it. And theoretically, again, the stock can continue to go higher. So remember, when you're long the call, when you own it, you are in control. And your risk is limited to what you can buy or what you pay for that option. But when you sell that contract, number one, you're at the mercy of the other side to decide if and when that option gets exercised, and your profit potential is limited to the proceeds of that sale, but your risk is unlimited. Okay. Now, a put contract basically gives you the opposite right, which is to sell, right? So you have the right, but not the obligation, again, if you're the buyer, to sell a specific amount of stock at a fixed price, which is known as the strike price, anytime on or before a specific expiration date. Okay. Now, if you are a put seller, if you're the seller, again, you're at the mercy of the other party to decide if and when you get exercised. But if you do, again, you'll be forced to buy the stock at the strike price, okay, whenever that option is exercised. So if you're the buyer of that put, your profit potential increases as the stock price moves towards zero. So in other words, if you're dealing with a $20 stock, the maximum profit you can ever have is those $20 because it can't go below zero, right? But as the price drops, your profit potential increases. But your potential loss, again, only if you're the buyer of the put option, your loss is limited to the premium that you paid for that put. Okay, so whatever you paid for it, that's your maximum risk. Now, if you're the put seller, your profit potential is limited again to the premium that you receive for the sale of that call. But your potential loss increases as the stock moves toward zero. So again, if it's a $20 stock, your potential loss would be, if the stock went to zero, the full $20. Okay. Let me just see here. I just want to make sure I'm up to date with there it goes. I can see the questions. Okay, perfect. Now, option premium. You'll hear that term, and what that is really the value of that option or what you're paying for. Now, what you need to remember is that one option contract is the equivalent of 100 shares of underlying stock. So if you buy one call, okay, and that call costs $1.50, you have to multiply that 1 times 100 because it's equivalent to 100 shares. So 1 times 100 times 150 would equal $150. Okay, so again, if you're the buyer of that call option and you spend $150, that is the max risk you will ever have on that position. Okay, so if it is worth it for you to exercise, you do so. If not, you let it expire and you lose your $150. Now you could sell in between. Again, we'll get into that, but it's that simple. So if you have 5 contracts, say, then it'd be 5 times 100. So it'd be the equivalent of 500 shares times the 150, and that would be your cost. Okay? Now, there are different types of options you can buy, and certainly there are thousands of optionable stocks out there. The option market over the years has become huge, and not only are there way more optionable stocks nowadays than there were several years ago, but there are different expiries now. Before, there will only be monthly expiries. Now there's weekly expiries on just about everything. Okay, but the options market is not restricted to equities. You can get options on the indexes like the S&P 500 and any other index out there. Also on futures, crude oil, gold, wheat, coffee, cocoa, you name it. There is pretty much an option on any futures market as well. And nowadays, many of them are very, very liquid, so they're quite easy to trade. There are different rules between the different products, between futures and equities and so on. There are different rules for those options, so you have to be aware of that. But otherwise, the options function the same way. Now, let me cover some key terms that you need to be aware of. The first one being in the money. Okay, when you hear a call option is in the money, that means that the strike price is below the current market price. So if you have a stock that's traded at $25, but you purchase the in the money strike at 15. So you bought the $15 strike, but the stock is trading at 25. That's what in the money is. You bought a strike that's below the current market price. Okay, out of the money means the opposite, meaning that your call price is higher than the current market price. Okay, so if that stock is trading at 25, but you buy the $30 call strike, that's going out of the money. And for puts, it's the reverse. Okay, remember, puts allow you or give you that right to sell a stock at that strike price. So whenever you're a put buyer, you're looking for the market to sell off. Whenever you're a buyer of calls, you're looking for the market to move higher. So when you're talking about in the money puts, your strike price is higher than the current market price. Okay, it's the opposite of the call. And when you're out of the money on the put, it means your strike is lower than the market price. Again, when I bring up the table and it's split between the calls and the puts, it'll be a little clearer for you, a little easier to demonstrate. Okay, at the money, your at the money strike is the strike price that's the closest to that current price, current market price of the underlying stock. So in other words, let's say that your stock was trading at $26, but the options on that particular stock went in $5 increments on the strikes. So in other words, you had a $25 strike and you had a $30 strike, right? But the stock's trading at 26. The 25 is the closest to the current market price, so that would be considered your at the money strike. Okay? Now, an options premium, the price of that option is made up of two different components: your intrinsic value, which is your in the money portion, and your extrinsic value, which is otherwise known as time value. So your intrinsic value, again, going back to the example where the stock is 25, but you purchase a call option strike at 15. So you're $10 below that $25 market price. That's your $10 of intrinsic value there. So if the actual option, when you went to buy it on the market, say was worth $12, it would cost you $12 for every option contract, okay? The $10 of that $12 would be considered intrinsic value, as where the other $2 would be considered extrinsic. That's the difference between the options price and the intrinsic value. Okay, so those $2 are factored in because of the amount of time to expiry. So the longer the time to expiry, the bigger the time value. So for example, if that option expired, say in 45 days from now, time value may be $2, but if it expired 6 months from now, the time value might be $5 or $6, right? And the longer the term to expiry, the higher the extrinsic value or time value portion that makes up that overall price, okay? Now, another thing you have to be very familiar with if you're going to play the options market is implied volatility. Implied volatility is the estimated volatility of the securities price, not the option price. This is one thing that a lot of traders get wrong, okay? It has to do with the underlying price. So if you're buying Apple stock or options on Apple stock, it's the estimated volatility of Apple stock, not the options on Apple, okay, that we're talking about. Generally, if volatility increases, that generally means the market is bearish. So like that recent pullback we had in March, right, that strong sell-off. If you look at just about any stock, any chart, you'll notice that the bars or the candlesticks before that drop were most likely fairly small from high to low. Okay, so the range of those bars was very tight until we started to drop, and then suddenly you started to get much bigger candles along the way. That's because the volatility increased dramatically. When the market sells off, that's when panic sets in, when people become very, very bearish, and that's when you get a lot of volatility coming into the market. During a bullish move, meaning a move higher in the market, generally implied volatility is fairly low because everyone's very calm, very happy that the market's going up. No one's panicking. There's nothing to worry about. Most people trade to the upside, and that's when things are calm. Okay. Now, a couple of facts before we get to the actual charts here. Options, you're going to hear a lot in the news about how risky options are. Well, they're only risky if you don't know how to trade them, because if you do, they're one of the safest things out there. Trust me, if you learn how to trade options appropriately, you'll probably never buy a single stock again, just the stock alone, I mean, okay? Because when you own just a stock, you're completely exposed to the market. There's no way to really protect yourself. Yes, you can try to balance a portfolio. So, you can hold some gold stocks while you hold some financials, for example, and, if financials drop and gold goes up, it'll mitigate the loss. But my point is, if you take one particular stock alone and you just buy that stock, you're completely at the mercy of the market. And if there's a big gap against you overnight or whatever, there's nothing you can do to protect yourself. And that's where options come in. Okay? Now, another fact is that over 80% of all option contracts expire worthless. Okay? So you'll see in a moment that it is in a way better to be an option seller, but you've got to be very comfortable with it, and I'll explain why in just a moment. Now, the real problem here is that most people buy options when they haven't learned enough about them and don't really take fair value and that implied volatility component into consideration. So what ends up happening is that they overpay for that option from the beginning. And then even if the underlying stock moved in the direction that they had anticipated, in other words, they called a move higher, even though the stock moved higher, because they overpaid for that option to begin with, they end up losing money on that option. Okay, and this is why I'm saying you really need to learn how to trade them properly. But if you do, they're very lucrative and one of the safest things out there to trade. So here's the difference between buying options and selling options. And when we're talking about an option, we're really referring to the performance of the underlying stock, because that's really what drives the price of the options. And there are only 5 possible scenarios when you're talking about a stock. One is that it moves in your favor big time. Second it moves in your favor but slightly. Third, the stock does nothing. It just kind of goes sideways. Fourth, it moves against you slightly. And fifth, it moves against you big time. Really, those are there are no other scenarios that are possible with a stock. That's it. But now, if we're talking about buying an option, okay, whether it's a call or put, if we're talking about buying an option, if that stock moves in your favor big time, of course you're going to make money, probably very good money. If it moves in your favor slightly, making money is not a guarantee. In other words, only if you took fair value and implied volatility into consideration and you bought at a fair price would you make money. If you overpaid for that option, you'd still lose money, even though the stock went in your favor slightly. Now, if it moves sideways, it really doesn't do anything, you're going to lose money because as that option gets closer and closer to the expiry date, that time value component will shrink, okay? So there is that extrinsic value decay that happens and that you have to be aware of. Now, if that stock moves against you slightly, you're going to lose money, and obviously if it moves against you big time, you're going to lose even more money. So when you're a buyer of options, even if you do take that implied volatility and that fair value and implied volatility component into consideration, and you do not overpay for that option, you still at best have a 2 out of 5 chance of making money on that option, okay? Now, I'm not trying to discourage you from buying. I pretty much exclusively buy options and do well with it. So again, it's really getting to know what suits you and which option strategy is best for you. But this is reality when it comes to buying options. Now, when it comes to selling, the same 5 scenarios can happen with the underlying stock. Nothing else is possible. But when you're a seller of the option and it moves in your favor big time, of course you're going to make money. If it moves in your favor slightly, most of the time you'll still make money because that time decay aspect is in your favor. And most people, remember, will overpay for these options to begin with, and then they'll settle back to their normal implied vol, and so you'll again be collecting that premium. Because remember, when you're selling an option, you want it to drop so that you can buy it back at a lower price and keep the profit. Okay. So now, if the stock remains the same, again, that time value component is going to shrink, and you're going to make money. If it moves against you, you'll still make some money. Again, because of the time value component that's squeezed, and because most people will overpay to begin with. Now, the only way you'll really lose money is if it goes against you big time. Okay, so regardless of the time decay, the move against you is just so big it puts you in a loss situation. So when you first look at buying options compared to selling options, it's a no-brainer, right? It's like selling options, 4 out of 5 chance I'm going to make money. Remember, this is the probability of making money, okay? But again, if you don't have a full understanding of options or are not trading the option strategy that suits you and your trading style, trust me, you'll still lose money, and probably a lot of it if you're selling options when you shouldn't be, okay? So let's talk about time decay, then we'll get to the charts and I'll explain how I do this very safely, and hopefully that'll help you do the same. When it comes to that time decay factor, if you're a buyer of options, you want to buy as much time as possible. Okay, now there's always a balance between cost and the amount of time you buy. You don't want to overspend, but you want to buy enough time, because that time decay happens gradually. But as you get closer and closer to expiry, it accelerates. So if you look at the bottom here, we had gone out 120 days, and you can see the difference from 120 to 90 is not very dramatic at all. Okay, then it accelerates a little, going down to 60 days, from 60 to 30 more, but really the bulk of the time decay happens in the final 30 days. So what I would tell you is, if you're a buyer of options, not only do you want to buy as much time as possible, but you want to be out of that position. In other words, you want to close out that option before you get to within 30 days of expiration. So whenever you get somewhere between that 60 and 30 day mark, you want to get out of there, okay? Otherwise, unless of course you're fully in the money and you have very little time decay left in that option, right? But if you do have time decay, you want to get out. Now, the flip side is true if you're a seller. If you're a seller, you want to own options that, or sell options that have 30 days or less to expiration, because you want that decay to happen as quick as possible, because if that price drops, you can buy it back at the lower price and keep the profit, right? So as a seller, you want to go 30, maximum 40 days out, no more than 40 days out on that to expiry on that option that you're selling, okay? So that's the difference. Buyer, you want time; seller, less time. Okay? So let's talk option strategies. There are dozens. Okay? Calls, puts, protective puts, spreads, straddles, callers, butterfly spread, you name it. There are dozens. And even these are the core strategies that have a name associated with it. There are many combinations within here that are not very popular but are also very, very possible. But tonight, I'm gonna stick to a couple of them. Long calls and puts. We're gonna cover protective puts, and if I have time, I'm gonna cover callers as well. But the key to understanding when and how to use each of these strategies is what's important. So don't think you need to trade them all. You do not. What you need to trade are the ones that you're comfortable with, that you're very familiar with, and that make you money. So, and if that's just long calls and puts, so be it. That's it. Yes, I do spreads from time to time. I will do callers. I'll do some straddles, but I'd say 95% of what I do with options is straight calls and puts, nothing else, okay? And I've been doing this for a very long time. So let me bring up my my TOS platform here. Let's talk about options. Now, before I get to the option chain, here's what I was talking about before. Look at the SPYs, okay, which is the ETF for the S&P 500. While we were moving higher, look at the size of these candles, okay? Let me zoom in a little so you can see them a little closer. You can see the range from high to low, very, very similar from one day to the next, and very low in range, right? As we started to sell off, here's where the volatility kicks in. Look at the size of these bars compared to these, okay? So on a chart, you can spot the area of implied volatility, but what will happen during this time is that the option premiums will become inflated, okay? Will increase dramatically, and so you have to be aware of that. So let's talk about buying calls. And I'm going to use Pfizer as an example. There's really no reason why I'm picking this, just came into my head. But let's bring up the option chain. And let's go out to September. So here on TOS, you'll see that the number in brackets, this is the number of days to expiration, okay? Options expire, most of them anyway, the monthly ones, on the third Friday of the month. So September 18th here. Let's open it up. What you see here is on the left of your screen is the call side, okay? And on the right is the put side, okay? And down the middle is the expiry date, and right here, this row here is the strike price. So you'll notice that for every option, there are numerous strike prices that you can choose. So if I'm buying Pfizer, or I look at this chart and I say, hey, I think there's a breakout about to happen here, and I'm not saying there is. I'm just saying hypothetically. Let's say that we're trading channels where we think it's going to bust out here and go higher. So if we think that we'd be interested in buying a straight call. Why would we be interested? Well, if we buy the stock, let's round it down. It's at $38, okay? So if I'm going to buy 1,000 shares of Pfizer, it'll cost me $38,000. Now, if that's all I do is buy 1,000 shares of Pfizer, I have $38,000 at risk. And yes, we can argue that this thing isn't going to go to zero tomorrow, but I'm at the mercy. Any bad news, anything that happens and the stock drops, I'm in for 38,000. I'm leaving myself open to a substantial loss. Now, if I want to buy the equivalent of 1,000 shares on Pfizer, I can go out to, let's just pick the $40 strike, okay, slightly out of the money here. And if I pay, say, $1.10 for this, right? For me to buy the equivalent of 1,000 shares, I'd have to buy 10 contracts. Remember, one contract is worth 100 shares, right? Is the equivalent of 100 shares. So I'd buy 10 contracts. So my cost wouldn't be, 10 times $1.10. It'd be 10 times 100, which is 1,000 times $1.10. Okay. So if I'm paying 1,000 times $1.10, okay, even if you go to the ask $1.12, whatever, what's my cost? $1,120. And remember, as a buyer, that is the most that I can lose. So now, by really getting the same position, I'm risking only a little over $1,000 compared to $38,000. Now, you're going to hear the term Greek, option Greeks, the delta, theta, vega, gamma. Those are important to know, but I don't have time to cover those today. All I will tell you is that the delta, for example, when you look at the $40 strike and come over to the delta column, it's 35. What that means is for every dollar move in the underlying stock, my option price should increase or decrease by 35 cents for every dollar move. Okay. Now that number is dynamic. It will change. So, if the stock goes up $1, yes, my option price should go up about 35 cents. But now the delta is going to change and go higher. It'll probably go to like 38 or 40, right? So the next dollar move, I'll make 40 cents, for example. That's the sort of thing. And if you go completely in the money, deep in the money, it'll be pretty much a 1-for-1. So yes, if you're only going to hold for $3 move and you bought the stock, 1,000 shares of the stock, you'd make more money than you would on the option. But when you're comparing the level of risk, there really is no comparison. Okay. Now you can just buy that, and on the flip side, if you think Pfizer is going to drop, you can buy a put contract. Okay. And that, again, will give you the right but not the obligation to sell those shares if you own them at a specific, at that strike price on or before expiration. But if you just choose to buy the contract itself, okay, because most contracts are not paired with the stock. Most are just a contract. So again, if I thought Pfizer was going to drop from here and I went and bought the $38 put, okay, I would spend $2. Again, if I bought 10 contracts, that'd be a little over $2,000. If I bought one contract, it'd be $217 basically, right? Plus commission, if any. So again, the risk is very low with, a considerable profit potential, okay? Now, if we're going to do a protective put situation, this is where this is how I prefer to trade puts, and this is where you buy them at the same time as the stock. So think of it this way. If you have the capital for it, okay, because if you have a smaller account, chances are you're not going to be able to put $38,000 into Pfizer along with more money on the put side. You'll just buy a straight call and only spend a few bucks, right? But if you have a bigger account, there are advantages to buying the stock and then protecting it with a put. Puts are basically can be used as insurance. Calls can as well if you're shorting the stock. It works the same way. But let's say we're going to buy Pfizer because we think it's going higher. 38,000 here. We're going to put 1,000 shares of Pfizer on the line. But we don't want to risk all 38,000, so we're going to buy some protection. We're going to come out here and we're going to buy a put. Now, if we want to go at the money, okay, and protect really 50% of it, the at the money strike is usually has a delta of 50, in this case 49, all right? So that's like hedging myself, right? And I'm protecting myself on that position. Because remember, anytime between now and the third Friday in September, regardless of what the stock does, I have the right to sell it at $38. So let's say they come out with news. We buy it 2 weeks later. There's news that they're going to cut their dividend, that their earnings report was horrible, whatever news you want to think of, or just the general market sells off. Let's say Pfizer goes from $38 to $5. And I know, yes, it's unrealistic, but we've seen this a million times when a stock's dropped over 90%. Let's just say Pfizer does. It goes to $5. It doesn't matter. It doesn't matter if it goes to zero for me, because I have the right to exercise my put and sell my stock at $38. Okay? And that's it. So yes, I will lose the money I spent on the put, but I will get my 38,000 back on that position. Okay? Now, there are all sorts of adjustments you can make along the way, because if it went down to 5, this option would be worth a heck of a lot more than $2, right? It'd be fully in the money, and it would be worth at least $33, right? And depending on how much time to expiration was left, even more than that. So you could sell the put at a huge profit, and then buy another put and hold on to the stock, sell a call against it to bring in some premium, lower your loss even more. You see where I'm going with this? One of the things we like to say about options is that with options, you have options, meaning you can make all sorts of adjustments along the way. And it's really almost endless. It's incredible how much you can do with that, okay? But let's stick to the basics. Now, your question should be, how much protection do I want? In other words, do I go in the money, at the money, or out of the money? Let's use the example of going in the money. Let's say I want to go $45 in the money. Well, let's not go that far. Let's go 40, okay? Let's look at 40. So I'm paying 38 for the stock. I'm paying another $3 and whatever, 3 1/4, let's say, for the $40 put. So my cost is the 38 plus 3 1/4. So that's 41 1/4, right? So my strike is 40. So the amount of risk I actually have on the table is $1.25. The 41 1/4 minus the 40, because remember, I can always sell my stock anytime between now and expiration for $40. So I really only have $1 and change of risk on the table. And if you ever want a quick way of figuring out how much risk you'd have by buying the stock and that put, look to the left of that, to the call side, because the premium on the call side is usually pretty much equal to the amount you would be risking by buying the stock and the put. So, you know, in our example was $1 1/4. You can see here it's $1.12 or so. It's very close. Okay. Now, let's say, now the downside of going in the money is that your delta is going to be higher. So if the put has a delta of 60, right? The stock, obviously, if it moves $1, it moves $1. It's 100 delta. But this one has a delta of 66. So, you know, if the stock moves up, this put is going to lose value. Now the stock, if it goes up $1, this put should lose about 66 cents, right? So really, what do we have as a net profit potential here? 34 cents to begin with, right? Now, for every dollar it goes up, this delta will drop and we'll make more and more money as we go. But initially, we're pretty much making 34 cents on that move, net, right? Because there'll be a gain on the stock, loss on the put, net profit overall. So if we want to leave ourselves a bit more room for profit, we have to drop our strike price on the put side. So let's say we go down to 35. Okay, now we're paying 38 for the stock. We're paying another $1 or so for the put. So now we're in for 39 and change. we have the right to sell this at 35. So now if we look at it at first glance, we can say, hey, we have $4 of risk, 39, sorry, total cost minus. Now, the advantage is that the delta is 28 here, meaning our net delta is 72, right? So now for every dollar move that the stock moves in our favor, you know, we make 72 cents profit net to begin with, right? And more and more as it goes higher. So that's one advantage. The disadvantage is we have to take a bit more risk. But do we really? And here's the one thing that you got to remember, and that is the benefit of having time value on your side. So when I say to buy as much time as you can, here's why. Let's say that we were to sell this right now. Okay, and let's say we bought it at a higher price, but the stock moved in our favor, the option dropped, okay, and we have a net profit, but we want to take this time value because since this is out of the money, this is all time value. That buck and change on this option is not intrinsic at all. It's all extrinsic. It's all time value. So as we get closer to September, this will start to drop closer to zero, right? But now that we still have a buck and change, let's look at this. Let's say $1.05. We can sell this for $1.05. So if we go to a very near-term expiry here, okay, let's go to this week's expiring tomorrow. What can we buy with $1.05, right? Well, if we look here on the put side, basically, we can at least buy the $39 strike. What was our cost to begin with? 39. It was 38 for the stock, a buck and change for the option. Our strike price was 35. But if we sell that, suck out all that time value and put that same amount of money into a near-term expiry. So we're not spending any more. We're not putting any more into a position. We're just giving up the time. We went from September to May, right? And now we can get out basically at break even, okay? And remember, if it doesn't go our way, right, and the stock drops, yes, we'll be in a net loss position, but remember, if the stock drops, that means the put's going up. So this dollar would increase, right? Would actually go much higher. So, you know, at that point, again, it's still out of the money. We suck out all that time value, go to the near-term expiry, and move up and strike. Okay, I hope that's clear. And I only have a few minutes left, so the only other thing I'll add is that to turn this position into a collar trade, how many of you have heard of the collar option strategy? Basically what the collar strategy is you own the underlying stock, you own a put for protection, but you sell a call against it. So for example, if I buy this at 38 and I buy that put at $35 here for $1, okay? Now I go to this side and I sell the $40 call against the stock, okay, which is basically a covered call. If you just look at the stock in the call option, okay. If you look at that, we're collecting $1 and change here, which pays the $1 and change we need for the 35 strike. So now the only thing we've spent is the 38 on the stock. But we have protection on the downside. And if it goes up, yes, we can get called away, right? If it goes up and moves above 40, it'll get exercised. But again, we sell our position at 40. So if it goes up above 40 and it gets exercised, we make a $2 profit, right? Our stock gets taken away at 40. Our cost was 38. Okay, and if it goes against us, this call will become worthless, which means we keep all that premium. So we've still paid for the put, and now that put will increase in value. We take that premium and we we go to a near-term option and we buy a much higher strike and then exercise and get rid of our position. So this is why options are much, much safer than just trading stock. And we're just scratching the surface here. There is a lot more that you can do with options. I'm talking about just the basics here. Okay, so what we do is what we can do is teach you all about options and the different strategies and how to use them appropriately. Okay, now if you go to tradingwins.com/SB, Stephen Bigelow's initials, tradingwins.com/SB, that'll take you to this page where it'll list all the things that we are offering for this training session. Now, it's a 2-hour training course, and we will cover a number of the strategies that we haven't here tonight, that we didn't have time for. One of them is selling credit spreads. Remember how when you're selling options, you really have a 4 out of 5 chance of making money, okay? But again, you have to know exactly when and how to use that strategy to have those odds in your favor. We'll teach you how to do that. Secondly, how many of you have heard of butterfly spreads? The thing about butterfly spreads is that they usually cost very little, and actually sometimes you can get them out of credit, believe it or not. You can open that position and collect some money for it. But if you're right about the position, if your prediction comes true, you can make 10 times your money or more on these. Okay, so it's really common where you're spending like $90 and pulling $1,000 out of that trade. We'll show you how we do that. Now, there are a lot of times throughout the year when the markets are sort of flat. You know, they go through a range after a strong uptrend or a strong downtrend. They just kind of go silent. We saw some of that over the past couple of weeks. That's when you can use delta neutral strategies, and we'll show you how to make money during those quiet periods as well. But one of the most important parts of this are the repair strategies. I gave you one tonight, you know, by lowering that time to expiry. But we'll cover different repair strategies. So if a trade does go wrong on you, you'll have some strategies in your back pocket to repair that trade. We'll talk about leaps. Leaps are long-term options that expire at least 1 year out, sometimes 2 or 3 years out. There's some real advantages to trading those, and we'll show you how. In addition to that training class, you'll get a 30-day membership to our Trading Wins Pro membership, where I will do a market recap every Sunday and send that video out to you. So it's getting you ready for the week ahead. But then during that week, we will get together 3 times during that week. We get together Monday afternoons, Wednesday mornings, and Friday afternoons live. All the members get together on a live call to ask me questions about the market. We review numerous charts, share trade ideas, all that. But that's a great time if you have any questions, whether it's on options or any other part of trading, to ask and get your question answered. All those sessions are recorded, and you will receive access to those recordings in your own section of your account. And you can watch those over and over again as much as you want, okay? And so all of that we're offering for just $7 here tonight. Again, it's the options course with a 30-day membership and everything that comes with it. Just go to tradingwins.com/SB. And now, if there's any questions, I'll be happy to take those, and I'll ask Stephen if he wants to jump in and help me out with that. Jake is saying, when is the course? Actually, we will send you a recording to that course. Periodically we do a live session, and so even if you've purchased the course in the past, you'll be invited to the new live class, and you can attend those as often as they happen, but so you don't have to wait till the next one, we'll send you a recording for that. So you can access that information. It's usually about half an hour after your order is processed, okay? So later this evening or sometime tomorrow, your account will be set up and you'll have access to it, okay? Anna says, if I choose not to stay with you, do I lose access to the videos? No, I think for some of our videos, yes, that is the case. This one, I don't think it is. I think you'll still have access to it, but regardless, you'll have 30 days to watch it as often as you want. And if you decide not to stay with us beyond the 30 days, just let us know. Drop us an email before the 30 days are up, and we'll just cancel your membership. CB is asking, how long is this offer available? Usually for about 48 hours or so. But again, we try to make this available to as many people as possible. I mean, there's a lot more information here than $7 worth. That I will guarantee you. Just one little item you pick up is worth way more than $7 here. So again, I think it'd be a great pickup here. Plus you get to spend 30 days with us. And again, if you have other trading related questions, you can ask me. And one thing I should say that I forgot to say is, for those live sessions we have with our members 3 times a week, if you can join us live, great. If you can't, they are recorded and you'll have access to the recording. But if you have a question that you want me to answer on those sessions but you can't join live, email those questions to me ahead of time. I'll answer them during the live session. That way, when you watch the recording, you'll have your answer, okay? Take down my email address. It is info@tradingwins.com. info@tradingwins.com. Just put it to my attention, and we'll go from there. Let's see. Jake is asking, does your course have the timing of the price of the stock involved as well? Or is it just as if we were selling based on the volatility option? No, this particular course, we're strictly talking about the options. So we're not giving you strategies of when to identify when a stock is going up or down. Obviously, for the 30 days that you're with us, you'll hear me talking about our strategies all the time during those live sessions, and you'll learn from that. But you can use this information with any strategy. So again, if many of you are using Stephen's candlestick strategies, this, I think, will be a great complement to it. Okay. Pat is asking, is there an annual subscription? Yes, there is, and it's offered at a discount. We have different promotions at different times, but before your 30 days are up, if again you want to send me an email on that, we'll give you the current promotion on that. But basically, it's you'll get 2 months free. In other words, you'll pay for 10 and get 2 free or so. But our staff will be happy to share that with you. Thanks, Liz. Thanks for taking part. Michael, no, the videos are not downloadable, but they will be in the My Account section when you log into our website. So you'll get a login ID and password. When you log in, you'll have a My Account section. When you click there, there'll be the courses that you've purchased. In this case, it'll be the high octane options, along with the recordings of the 3 weekly sessions that we have, the 3 market chat sessions that we have every week. Okay. Let me see if there's any other questions I missed here. I think I've gotten them all. Let me just go back a little and see. When the volatility in a stock goes up, the higher the probability of the options reaching the strike price. This is measured by something calculated. Okay. Yeah, Jake, I mean, we'll go over the details of those, of implied volatility and so on in more detail in the course. So I'm going to leave it at that. I'm not going to go into a further explanation on that just now. I think you had asked that question while we were going through it, so maybe I already did. But anyway, we'll go through it in much more detail. Jake is saying, I went to the site and it offers a 14-day trial for the $7. If that's the case, then that is incorrect. You can go ahead and sign up and then send me an email at info@tradingwinds.com and we'll have that extended to you. Okay, sometimes we do have a 14-day offer. This time we decided to do 30. If that adjustment wasn't made on the site, I apologize, but by all means, it is going to be 30 days. I will honor that, I promise you. So go ahead and sign up and flip me an email and we'll extend that without a problem at all. D-Max is asking, do you provide a list of best option candidates to trade? No, I mean, certainly not during this course, but during the 30 days when you join our market chats or watch those recordings, we share trade ideas all the time, and our members usually come to those sessions with a list of symbols, of charts for us to review, and I'll give you my opinion on it. So a lot of trade ideas come out of those sessions, as well as other technical analysis techniques and option strategies and so on that we talk about. Basically, we have a very diverse membership. We have people that are just starting their trading journey and others that have been members with me for over 8 years, and have been trading for a lot longer than that. So through the questions that are asked during those sessions, a lot of other topics are discussed, and you'll learn a lot as we go through it. Barbara's asking how my option membership is different from Steven's. Ours isn't really an options membership. We're offering this options course, but our membership is just a Trading Winds Pro service where you basically get access to me 3 times a week during those sessions, and we cover a number of different topics. And there's that market recap that I send out on the Sundays. I'm not entirely sure or aware of what Steven's option subscription is comprised of, but I'm sure he'd be happy to share that with you. So I think I'm out of time. I will pass it back to our host and just say thank you very much to everyone for taking the time to be with us tonight, and thank you to Steve and Becky and everyone else there for having me on. I hope we can do this again sometime.
All right, Vince, thank you very much. Yeah, the answer to how is it different is Vince is often requested to come, or we get a lot of requests to have him come back. He's probably one of the best option trade specialists that you're going to run across. Quite often we have guest speakers on here, and the feedback is usually this guy is not very good, or I've seen his stuff, it's crapola. Every time we have Vince on here and people that use his service, there's nothing but high accolades of what he shows them. I mean, Vince is one of our best, I want to say, feedback respondents, that people love what he teaches. So try it. You're going to get well more than your money's worth. And we like to have people have different perspectives on different strategy or trading strategies, because my trading strategy might be easy or comprehensive to some people, but other people don't get it, and they need another point of view. Vince is probably one of the best option trading specialists you're going to run across. So give it a try. You're going to get well more than your money's worth. So Vince, once again, thank you very much. You give good information. So with that, everybody have a good evening. Try Vince's information. It's good stuff, or we wouldn't be having him on here. With that, everybody have a good evening. We will see you bright and early in the chat room.